Question 51. A 180-day money market instrument is quoted at a discount rate of 0.476% for a 360-day year. The bond equivalent yield of the instrument is closest to. So we've got 0.476, which is the same, 0.483 or 0.494%. So the main difference here between money market and the bond equivalent yield is going to be, for money market we use 360-day yield, 360-day year. For the bond equivalent yield we're going to be using 365. So we essentially need to figure out what the price of our bond is under money market quote, and then we'll re-quote that out for bond equivalent yield using that longer year. So the first thing we're going to do, let me pull this in, is we're going to find that the value of the bond. And so to do that, we're going to take future value, which will be redemption amount, 100, and then multiplying that by 1 minus the days over year. So like I mentioned, we're using year as 360 here. So this is going to be 0.5. And then we're multiplying that by the discount rate. So the discount rate is 0.476. So just to mention here too, when we're multiplying this out on our calculator, we really want to make sure we're multiplying these first. So we would have two sets of parentheses, so we have this parentheses around all of it. So we want to make sure it looks like that. So we're multiplying this out first. That gives us this number here, and then we're subtracting that from 1, and then multiplying by 100. So we get 99.762, and then part 2 of this operation is going to be figuring out that bond equivalent yield. So to do that, we're going to take year over days, and we'll be using that 365 for bond equivalent yield. So 365 over 180, and then multiplying that by essentially the redemption value minus present value over current present value. So that brings us to 2. This gives us a little over 2, and then this is 0.238. So multiply that, or divide that by the starting value of the bond, and then bring that down here even more simplified, and it gives us approximately 0.00483 with some rounding, or 0.483%. Answer B. Question 52. The current market price of a 3-year floating rate note paying the 6-month LIBOR plus 0.25% on a semi-annual basis is 98.7 per 100 of par value. The current 6-month LIBOR is 1.05% and is expected to remain constant. Given that the interest rate payment each period is 0.65 per $100 par value, the discount margin is closest to. So our discount margin is the spread over the reference rate for the security, and it ends up equaling the present value of all the future cash flows of the note. So I'm going to pull in the formula for that below. And so we have this formula here, and the numerator essentially is going to be the cash flows. So it's going to be those coupon payments. So we've got index, which is going to be that LIBOR quote. And then the QM is that spread. And then FV is going to be our par value. So we multiply that by the par value to get the coupon. So then our coupon payment ends up looking like this. So we've got 1.05%, that 6-month LIBOR, and then what we're paying above that, the QM, 0.25%. And then multiplying that by the par, and then the M is our basically how many payments per year. So we're doing semi-annual for 6 months, so divide by 2 to get the semi-annual payment. So from there then, we're going to be discounting all of those cash flows back to the present value. And when we do that, that gives us our price, which we're given. So basically we're given all of this, and then what we need to do to find R is we need to solve. So we're given we use this finding R. So we're going to do this using time value of money calculation. So let me pull that in and we can do that right now. So we're going to have 0.65 for our payment. And then our period is going to be 3 years every 6. So we're going to have every 6 months. So that's 2 per year. So we're going to have 6 for N. Our present value is going to be that 98.7. Which would be, and then we'll have par for future value there. So when we compute our interest rate, we get 0.08733. So that's going to be our R. So now we can solve for this formula to get the discount margin. So the discount margin is going to be index plus discount margin equals R, and then divided by the number of periods. So then from here, we have all the numbers. We just do the algebra out, and we can see that rounds to answer B, 0.7%. Question 53. The table below summarizes selected financial information concerning a textile manufacturer for the year 2013. So we've got all the financial information here. Let's look at the what we're asking for first. The manufacturer's FFO, so funds from operations to total debt, is closest to. So we're given total debt here, so we've got that for our denominator, so we need to calculate FFO. So to do that, let's pull in that formula and what that looks like. So that's going to be net income plus depreciation, so the non-cash expenses, minus gains on sales of property. And we're taking out gains on sales of property because that's not technically funds from operations. Those are going to be kind of like one-offs that we're gaining that one period. So we don't want to consider that as heavily for part of the financials. So that's going to look like our net income, 450. We're going to add back non-cash expenses, which would be that depreciation and amortization, and then subtract out the gain from long-lived sales. And when we do that, we get 456. So 456 divided by 500 brings us right there to answer C. Question 54. A limitation of using the current yield to evaluate fixed income security is that the measure ignores. So current yield, pretty straightforward. It's just going to be our annual income over current market price. So that in mind, let's take a look at these. A, weekends and holidays. It does not ignore weekends and holidays. It's just taking that annual income for the year and divided by market price. It doesn't have anything related to kind of days of compounding in the calculation. B, the flat price of an issue. So it also does not ignore the flat price of an issue, since the flat price of an issue is the current market price, which doesn't include kind of accrued interest, essentially, is what the flat price is. And then C, time value of coupon payments. This is correct. By doing it this simply, essentially, we're kind of ignoring coupons. If that annual income is paid out monthly or quarterly or semi-annually, then we're not properly kind of compounding those payments over time. So that's where we lack here. Answer C. Question 55. A U.S. Treasury bill with a par value of $1 million USD and 200 days until maturity is selling for USD 990,000. Its bank discount rate is closest to. So let's pull in that formula here. Our bank discount rate is going to be present value equals future value, which will be that par. And then we're going to multiply that by 1 minus the days over year. So we're going to be using 200 days, and then for year we always use 360. And then multiplying that by the discount rate. So discount rate is what we're going to be solving for here. We're given all of these other values, but we need to solve for discount rate. So when we do that, let's pull this in. So we get 990 equals $1 million times 1 minus 200 divided by 360 times X. And then when we do out some of this math, we're basically just doing algebra at this point. So then we get 990 equals 1 million minus 555.56x. And then we get x equals 990 minus a million divided by 555 minus etc. Gets us 0.018 or 1.8%. Answer B. Question 56. James Cunningham is evaluating the factors that influence issue ratings. He has identified and described 2 factors, which he has summarized below. Factor 1, the higher the senior unsecured ranking, the lower the notching adjustment will be. This is a correct statement. Essentially, the higher this is ranked, that means there's less debt above it in the capital stack, making the notching adjustment lower, essentially. And then 2, in the case of structural subordination, the debt of the parent company is serviced before that of operating subsidiaries. So this is flipped. So in this case, the debt of the operating subsidiaries is serviced before the debt of the parent. So this this statement is not correct. Cunningham is most likely correct with respect to factor 1 only. Yep. Factor 2 only. Nope. Or both factors, we can rule that out as well. And we will go with A, factor 1 only. Question 57. The value of a European call option is inversely related to the. So inversely related meaning when when this goes up, that means the call option value goes down. So A, exercise price, all else equal. If a exercise price is higher, this is going to be inversely related to the call option. So if the exercise price is 50 versus 60, we're looking at a call option. A lower exercise price means we're either more in the money or closer to being in the money, which will increase the price of the option. A higher exercise price will lead to a lower option value. So A looks like our answer. Let's make sure we can rule out B and C. B, time to expiration. There's going to be a direct effect here. So as time decreases, this is going to decrease the value of the call option. And that's because there's less, basically time for that option to get into the money. And then C, value of underlying. There's a direct correlation there. If the underlying goes up, the value of the call option is going to go up, or vice versa. So we'll stick with A. 58. Consider a call option with a premium of 21 and a strike price of 81. The maximum possible profit for the writer of the call is closest to. So the writer of the call, this is the person who is selling the option. So they're going to be collecting this premium. And then the person on the other side of that has the right but not the obligation to buy the stock at 198. So when we're the writer of the call, we're collecting this premium, and then we're basically hoping that the stock price drops. And so if the stock ends at $190, or whether the stock ends at $190 or it ends at $10, as long as it's below this, we're going to be collecting $21. We can't make any more money than the premium that we're collecting. But if the strike price is at $200 or $500, then we're going to be not making this full premium. So max possible profit for the writer of the call is going to be equal to the premium A, since we said your upside is basically limited to what you collect on premium. Question 59. A US-based company has a subsidiary in Germany from which it expects to receive 8 million euro in the next 3 months. If the company's management is concerned about foreign currency, it will most likely enter into A. So we're a US-based company and we have a subsidiary in Germany, which we're receiving 8 million euros. So right now we're long euros essentially because we want the value of the euro to increase, which will then mean we'll get more dollars. So we are long euro. So if we're concerned about foreign currency, we want to hedge. So our forward contract needs to be going short euro. So let's, with that in mind, let's take a look at these. And because we're taking the opposite position, essentially whether the euro increases or decreases, our forward contract then cancels out any fluctuation in what we're expecting to receive. So A, currency forward contract by taking a short position in the euro. That sounds like exactly what we want to do. If we're short the euro and the currency, but long it on our business side, then we're kind of canceling out those two positions, and we're not exposed to fluctuations there. B, currency forward contract taking a short position in the dollar. We're already short dollar, so this would exacerbate our foreign currency exposure. C, forward rate agreement by taking a long position in the euro. Again, these are both exacerbating our current position, which is not what we want to do if we're concerned about foreign currency. We want to hedge. Question 60. John Cabot, a derivatives trader at AFK Bank, takes a long position in the 200,000 June 2019 gold futures contract. Which of the following parties will most likely have the opposite position to the futures contract? A clearinghouse. That is going to be our answer. Because we're trading futures, these are exchange traded. And when we're trading on an exchange, the clearinghouse is always going to be on the hook for the other side. So they're going to be the ones on the hook for that futures contract and ensuring that it's filled essentially. B, a mix of retail traders and investors. They could technically be on the other side because they may be going short the futures, but they're not going to be responsible of kind of fulfilling our futures contract. The clearinghouse will be, so we can rule that out. And then C, other derivative traders at large banks. It's going to be the same as kind of the same answer as B. And, if we were doing forwards OTC, that's where we would go with answer C, where we would directly have other institutions or people on the other side of that trade.